Welcome back, Navigators. Today's video will teach you how to spot the red flags and green lights to invest in the stock market using the same economic indicators that Wall Street pros rely on. We're diving deep into the top 5 economic indicators every investor must know. Whether you're a seasoned investor or just starting out, understanding these indicators can help you anticipate economic cycles and adjust your strategies. These knowledge will assist you in anticipating economic cycles, whether it's a recession or a period of rapid growth, and adjust your investment strategies accordingly in order to maximize gains or mitigate losses. Our first indicator, the GDP growth rate, can be likened to the heartbeat of an economy. It measures the total value of goods and services produced within a country, providing a snapshot of its overall economic health. A strong GDP growth rate signals a robust economy, inspiring confidence in businesses and investors. Similarly, a growing GDP indicates an economy brimming with activity. Businesses are expanding, consumers are spending, and the stock market often reflects this optimism. However, a decline in GDP growth can foreshadow an economic slowdown. For instance, the 2008 financial crisis led to a sharp contraction in the US GDP, mirrored by a significant downturn in the stock market. Strong GDP growth often leads to higher corporate earnings, which can boost investor confidence, leading to stock price increases. Conversely, when GDP growth slows or contracts, it suggests that businesses may face reduced consumer spending, weaker demand, and lower profits, which can lead to stock price declines. For example, during periods of robust GDP growth, cyclical stocks like industrials or consumer discretionary tend to outperform. On the other hand, weak GDP growth might make investors turn to defensive stocks, such as utilities or healthcare, that perform relatively better during downturns. Our next indicator takes us into the lives of the workforce. The unemployment rate, representing the percentage of the labor force that is jobless, serves as a barometer of people's livelihoods. A low unemployment rate generally indicates that businesses are confident enough to hire, consumers have more disposable income, and the stock market often responds positively. Conversely, a high unemployment rate suggests a lack of job opportunities, potentially leading to decreased consumer spending and a decline in economic activity. The COVID-19 pandemic provides a stark example, with the unemployment rate in the US soaring to levels not seen since the Great Depression. This surge coincided with a sharp decline in the stock market, highlighting the interconnectedness of these two forces. As regards the impact on stocks, a declining unemployment rate usually bodes well for stock markets because it suggests that more people are earning wages, which increases consumer spending. This in turn boosts corporate revenues and profits. Cyclical stocks, such as retail, automotive, and leisure, tend to benefit when unemployment is low due to increased consumer demand. However, if unemployment falls too low, it could lead to wage inflation as companies compete for workers, potentially cutting into corporate profits and leading to tighter monetary policies, higher interest rates, which could negatively affect stock prices. Conversely, a rising unemployment rate may indicate weaker economic conditions, causing stock prices to fall, especially in sectors sensitive to consumer spending. Inflation, often referred to as the silent thief, can erode purchasing power over time. This indicator measures the rate at which the general level of prices for goods and services rises, impacting everything from the cost of bread to the price of a new car. When inflation rises, the purchasing power of our money diminishes. For investors, rising inflation can impact the stock market in various ways. Inflation affects stocks differently across sectors. For instance, high inflation typically leads to rising interest rates, which increase the cost of borrowing for companies. This can reduce profit margins and result in lower stock prices. Growth stocks, particularly in the tech sector, may suffer more during high inflation because their future earnings, discounted back to the present, are less valuable. However, some sectors, such as energy and materials, can benefit from inflation as the prices of commodities they produce tend to rise. In times of low inflation, borrowing costs are lower, which can spur business investment and growth, benefiting most stock sectors. However, not all inflation is detrimental. A moderate level of inflation, around 2%, can actually be a sign of a healthy economy. The key is to monitor inflation trends and adjust investment strategies accordingly. Interest rates, often likened to the puppet master of borrowing costs, play a pivotal role in influencing economic activity and stock market movements. Set by central banks, these rates determine the cost of borrowing money for individuals and businesses alike. Lower interest rates make it cheaper for businesses to invest, for consumers to borrow, and for the overall economy to grow. Lower interest rates often translate into increased consumer spending and business investments, which can fuel economic growth and create a favorable environment for the stock market. Conversely, when interest rates rise, borrowing becomes more expensive, potentially slowing down economic activity and impacting stock market performance. Understanding the dynamics between interest rates and the stock market is crucial for investors. For instance, when interest rates are low, growth-oriented companies, particularly in sectors like technology, tend to benefit as they can borrow cheaply to fuel their expansion. The Consumer Confidence Index, a measure of consumers' feelings about the current and future economic conditions, acts as a compass, guiding us towards understanding consumer behavior and its potential impact on the stock market. When consumers are confident about the economy, they are more likely to spend, invest, and drive economic growth. This positive sentiment often translates into a bullish stock market. Conversely, when consumer confidence wanes, consumers may become more cautious with their spending, opting to save rather than spend. This hesitancy can signal an economic slowdown and potentially impact stock market performance. Monitoring the Consumer Confidence Index can provide valuable insights for investors. For example, a surge in consumer confidence might signal a good time to consider investing in consumer discretionary stocks. As a word of caution, keep in mind that these indicators are not crystal balls, but powerful tools that can provide valuable insights into the stock market. By incorporating this knowledge into your investment strategy, you can navigate the financial markets with greater confidence, learn more, educate yourself, and keep a disciplined approach over your investing life. That's all for today. Until next time, take good care of your finances, navigators, and don't forget to subscribe and share if you found any value.